Let's analyze a recent change made in Budget 2017 with respect to a very specific transaction which is known as a Joint Development Agreement. You may have heard of this term in recent times as it has become very popular. Now, what's a JDA? A JDA is essentially an agreement between two persons, the owner of a land and a developer. Under the JDA, the owner of the land hands over the land to the developer for the purpose of development. In return, the developer develops the property and gives back the land along with the houses that he has built on the land. In a typical transaction, the owner of the land should pay the developer for the construction in cash. However, in a JDA, it does not work this way. So what are the benefits which are available under a JDA? Let's assume that 4 houses are built on this piece of land. The owner of the land gets to keep 2 of those houses and the developer retains the balance 2 houses as payment for the development. Now, what are the issues which can arise in such a transaction? The first issue is the year in which the capital gains tax would be attracted. As you can see, there are a lot of options. You may pause the video and take a look at these options. Earlier, it would be taxed in the year in which the land was transferred to the developer. But with the introduction of the new provision, section 45(5)(a), the capital gains in case of an individual or an HUF shall be chargeable in the previous year in which the certificate of completion for the whole or part of the project is issued by the competent authority. This in effect pushes taxability from the year of transfer of the land to the year of completion and the issue of the certificate for the completion. This may prove to be beneficial from the owner's point of view as the taxability has now got postponed. Now, the second issue which can arise is what would be the amount of sale consideration on which the capital gains tax must be computed. As per section 45(5)(a), the tax would be computed on the stamp duty value on the date of the certificate plus any monetary consideration received in addition to the houses that the owner receives from the developer. Now let's see a simple case study and understand how these provisions come into effect. Now, in the given case, Mr. X purchased a residential plot on 1/1/1998 for rupees 50 lakhs. The fair market value of the plot on 1/4/2001 is rupees 65 lakhs. Alpha Builders enters into a development agreement with Mr. X on 1/5/2017, which is PY 1718, on the following terms and conditions. Mr. X will hand over the possession of the plot to Alpha Builders on 1/5/2017. Alpha Builders will pay a check of rupees 60 lakhs to Mr. X the same day. 10 residential units will be constructed and 6 will be handed over to Mr. X on 30/6/2019. In other words, 4 will be retained by the developer as payment. The stamp duty values are also given to you. The stamp duty value of the plot on 1/5/2017, that is the date of transfer of the plot, is 2 crores. The stamp duty value of each flat on 30/6/2019 is rupees 45 lakhs. I hope you remember that there are 10 flats which will be constructed and the stamp duty value of each flat is 45 lakhs on 30/6/2019. The project completion certificate is issued by the competent authority on 30/6/2019 and on the same day the 6 units are handed over. Now let's see the elements that we need to pick from this question while calculating the capital gains. Firstly, the year of taxability. The year of taxability would be PY 1920, the year in which the project completion certificate is issued. The second thing is the sale consideration. The sale consideration is twofold here. The stamp duty value of each flat is 45 lakhs multiplied by 6 flats that he receives. In addition, he has also received a consideration of 60 lakhs in the form of check. Both of these will be considered as the full value of consideration, or FVC in short. Thirdly, the cost of acquisition. If you see the first line of the problem, the cost of acquisition is 50 lakh, but the fair market value on 1/4/2001 is 65 lakhs. Since the property has been purchased before 1/4/2001, Mr. X has an option to choose between the two, and he would obviously opt for the higher of the two, which is 65 lakhs as the cost of acquisition. Now, using this, let's compute the capital gains. The full value of consideration would be the stamp duty value on the date of issue of certificate, which would be 45 lakhs multiplied by 6 flats, plus the monetary consideration received to the extent of 60 lakhs. If you total it up, you would get 330 lakhs. Mr. X can take the cost of acquisition as the fair market value on 1/4/2001, which is 65 lakhs, and index it. Once computed, the long-term capital gain tax would have to be paid on the gain of 1,53 lakhs 20,000. I hope the provision of section 45(5)(a) is understood by this illustration. Now let's consider in the same illustration, instead of Mr. X, the SSE was a company. Then in such a situation, 45(5)(a) would not come into effect. The old provisions would still be applicable, and the taxability would be in PY 2017-18 itself. That is the year in which the land is transferred to the developer. Now the full value of consideration would be the stamp duty value of the plot on the date of transfer, which is 2 crore. The cost of acquisition can still be taken as 65 lakhs and can be indexed as well. If you notice, the long-term capital gain in this case is much lower than in the previous case. So this provision may not really prove to be beneficial, as it may result in a higher tax to be paid by the individual. But the benefit of this change is that the taxability gets pushed to the year of completion. But remember, the change is applicable only to an individual or an HUF. Now there can be another issue in this. Now Mr. X has earned a long-term capital gain. Can he now reinvest the long-term capital gain and claim the eligible exemptions under these sections? Yes, it is possible, but subject to the conditions being fulfilled as per those sections. For example, section 54F requires the SSE to purchase a house property within 2 years from the date of transfer and construct a house property within 3 years from the date of transfer. Now the date of transfer would still be the date of transfer of the land, so Mr. X would need to reinvest within 2 or 3 years, as the case may be, from 1/5/2017, which may not be possible if he does not get the land back along with the property within 2 or 3 years. So although these changes have resulted in some sort of a positive effect for the taxpayer, it may still result in higher tax being paid by the SSE due to these changes.